How to grow a small trading account. An interesting question, don't you think? For those of you who don't know me, I'm Rob, and for those of you who do know me, guess what? I'm still Rob, and I'm still here. Hey, it's Coffee with Rob. Let's have some coffee. Always good. Been doing this for 30 years, and I'm going to tell you a little story about trading before we get to the charts. And I'll show you on the charts a system, a price action system that you can use for your day trading that'll give you high probability trades. And then after the charts, I'm going to show you a strategy that'll make you money in the markets. But before we go there, let me tell you a little story about trading and how I started 30 years ago and what happened to my small trading account, how I grew my small trading account when I got started all those years ago. When I started trading, we didn't have geared trading. We didn't have all these luxuries that you have now of 1 to 100 or funded trader markets. By the way, if you want a funded account, I do have a link in the description for you as well. That said, there's a free Forex book as well. If you want to trade Forex, we didn't have all those luxuries back then. Let me tell you the story. I did a course. I went and I got a course, and I think it was from ShareMax or something like that. It was a big file this size, huge file. And in that course was a whole bunch of complicated stories and information and charting and pencils and that sort of stuff. There was no computers, there was no algorithms, there was no factorial stuff or anything like that, which is why I always tell you guys that the squiggly lines don't make you money, that the charts don't make you money. The market's made up of traders, and the traders are trading against you, and you are trading against them. Every squiggly line that you see, every candle that you see is all about the movement in the markets, what the other traders are doing. And you're looking for liquidity in the market so that you can make money out of the markets as well. Hey, it's Coffee with Rob. Let's have some coffee. Always good. Here's the story. When I was younger, I bought this file and I started trading, and I had very little money to trade. And I couldn't take $1,000 and turn it into 100,000 like you can do now. So what was I going to do? Well, the only thing I could do was trade in shares and invest in shares. And that's what I did. I looked for the best trades that I could find, the best shares that I could find, and I started investing my money in the markets. And I hit one or two. I mean, one of the shares that I actually hit way in the I can't remember how many years ago this was, but it was quite a while ago. I invested in a company in South Africa called Steinhoff, and I invested at a really, really low price. 5, 6, 7, 8, 9, 10 rand. I can't even remember what I started at, but it was a really low amount. And I put my money into this company, and it wasn't a penny share. It was a good company. It looked like a good company. It was the darling of South Africa for quite a while. And lots of other traders were putting their money in there, which sort of inspired me to do the same thing. Put my money into this. And over a small period of time, it wasn't even 10 years. It was a matter of 2, 3 years, 4 years. It rose up and it touched $90, 90 rands. I'd made so much money out of this because I'd bought a lot of shares. Because when you buy them at cheap rates or cheap amounts, like 5, 6 rand, you can buy thousands of shares. And when it gets to 90 rand, it multiplies. And it got there really quickly. And then I saw it start dropping off, and they started to list in Frankfurt. And I was waiting for this listing to take place because it was all exciting. It was all really exciting. And it was about, if they listed there, it was just going to double in price, and it was just going to double my money. So I was holding on, and I was watching this, and then I heard the magic word. The magic word came through, and that magic word was fraud. They were investigating fraud. The Frankfurt Exchange was investigating fraud on Steinhoff, and I thought, wait a minute. Now, even the guy from Pep, what was his name, Chris, whatever, the CEO, they'd invested heavily into Steinhoff as well, Pep Stores, which was quite insane because they had invested, so that had made it a big company as well. Christo Visa, I think his name was. And, at the end of the day, this guy was stood to lose an absolute fortune based on what was happening with Steinhoff. Now, my money was in there, and it had reached the 90, and it dropped back into the 80s, and then it dropped back to 80, and it went into 79. And I looked at this and I heard that word, and I said, you know what? Gut feeling, I'm out of here. I'm taking my money and I'm going because I've made so much money on this share. Let's not lose it all, eh? Let's take this money and put it into something else until that's all settled down. If it doubles up, so be it, we walk away because I've got these investments going. And at that time, I was literally watching my trading. I was keeping an eye on it. What I do when I invest now, you guys that know me, I just buy shares, I set and forget them, and I don't look again. I just leave them there. Unless the word fraud comes up or something like that, then I really start checking it out again, because that is concerning, or Ponzi scheme, whatever the case. For those of you who know me, you'll know that I do not invest in crypto, because I believe crypto is fresh air, for example. There's no asset value, there's no growth in it, so I wouldn't invest in something like that. That share, actually, I sold it at the highest I could possibly sell it, because from that moment on, within a week or two after I'd sold it, it came crashing down. It came tumbling down. It fell off the cliff, started heading down into the doldrums. Eventually, that share hit 1 or 2 cents. And at that point, we were all quite shocked, because people were still buying it, and it was bankrupt. Let's be honest. It was done. Yet some people were still buying it. Then I looked at it and I thought, now it's probably short covering or something to that effect. But bear in mind, guys, this was somewhere in the middle of my trading career, or further along, because we had computers then, we had algorithms then, and I was doing gear trading as well at the time. It's not that long ago, maybe 10, 15 years ago, not that long ago at all, maybe even less. Not that I can remember 100%, but I'm just mentioning that story in amongst many other stories where I invested in shares, and I invested at a very low rate, and they shot up and they went to an extreme rate. Guys, if you want to take a small account and turn it into something big, you actually need a bit of time. You need time to do that. You need to be able to put money into shares, sit back, wait for that to grow. If you want to do it with trading, I'm going to show you a charting system now that's going to help you with the high probability trades, and then I'm going to show you a strategy that will most likely help you become profitable in the markets. But you're going to have to trade with very small amounts of money, and when you gear it, you're going to have to look at your strategy as to how you gear it and how much you can trade. But that kind of story is to inspire you to think that if you spend time in the market, and if you think about your trading, if you think about your investments over and above your trading, that's what's going to hold you in good stead in the future. So if you're a younger guy, let's say you're in your 30s or 40s, even younger would be better, but you've got the time to put money in the market now. What you've got to do is, if you have a lump sum, take a lump sum, invest it in a couple of shares, and then every month take an amount and keep adding it in there, same amount. And every year, if you can, increase that amount a little bit into the investment account. Guarantee you, 20, 30 years time, you're going to look back and you're going to thank me for that. As long as you stick with it, and as long as you don't close the account, and as long as you don't pull the money out, you'll be okay. If you can eventually get up to 10 shares, that's your best position to be in, because then if one crashes completely and you don't see it happening, then it's only a 10% loss on your portfolio. Keep that in mind. But guys, let's go and have a look at the charts, and I'm going to show you a price action system that will help you with your trading, that'll give you those high probability trades to get you those trades and get you ahead. But after the charts, sit back, listen to the strategy. So now you want to know a little bit about the high probability trading systems that we use. So that's what we're going to show you now. We're going to show you a high probability trading system. Okay, this is Brent crude oil. We are in a sell on the Brent crude oil. We took the sell. We're waiting for it to play out. It's hanging about, and sometimes swing trading can take a long time to play out. What we have here is the trend resistance, and as long as we stay below the trend resistance, we remain short on this trade. Above here, we have our main daily resistance. We have our main daily support. So let's just take this out the way. Let's just take this out the way and make the chart a little bit bigger so that we can play around here. What we do to get these levels, very simple. We trade with price action. We don't need to use all these MACD, stochastics, Fibonacci's, golden areas, and whatnot. We just simply use the price action. And we keep it simple, guys. Don't get overcomplicated. There's no need to overcomplicate trading. This is only high probability. You know, all this does is give you probability. The strategy I'll show you after the charts. The strategy is what will make you money. This won't make you money. This will help you to choose your trade. That's all it's going to do. Help you to choose your trade. Now, the first thing I do is I take it to the day chart, and the higher time frames give me more reliable information. And you're going to say to me, Rob, why does the higher time frame give me more reliable information? Think about it this way. If you have a test to see how good something is, let's say it's a trading system, you want to try it out. You put 5 traders in the room, Try the system out. 3 of them come back to you with success. 2 of them come back to you with failure. You've got a sample size. It looks good. It looks positive. Now you start your billion-dollar company based on those 5 traders. Whereas the guy who took 100 traders and put them in a room and tested the system found out that 80 were unhappy with it and it failed. Now you've got a 20% success rate and an 80% failure rate. Which one do you think is going to be more successful? Obviously, guys, the guy with a higher sample rate is going to have a better success rate. Now, the same thing works with trading. If you take levels from the day, you've got a whole day's information in every single candle. So the chart's giving you daily information, which is much more reliable than 5-minute information. 5-minute information can move up and down 100 times in a day, whereas your daily information gives you solid, possible probabilities for the future. Because when you take a trade on a chart, what it's about is not about fractal, it's not about maths, it's not about algorithms. These are all traders in the market, and what you're looking for is the high probability. Human beings are creatures of habit. Human beings are creatures of habit. In other words, what they did in the past, in all likelihood, they'll do it again in the future. That's what human beings do. So what human beings do is they leave orders in at certain areas, round numbers, could be just areas where prices have got to before, and like sheep, they just follow each other around. Resistance levels, they look for those round numbers, they look for those areas where the price has been before. And they all do the same thing, and that's what we do as traders. We're all doing the same thing. So what you do is you move it to the day, and then you put it on a line chart. Why do I put it on the line chart? Because on the line chart, you get closing prices, which are much more reliable than highs and lows. Highs and lows can be spikes. And you've seen how we got spiked out of a number of trades in the last couple of weeks, and it was just a black swan event. Somebody stood up and said something, and a spike comes along and takes out your trade. Now you want to trade your levels on spikes. You don't want to do that. You want to trade your levels on reliable closing prices, because the reliable closing price is the price for that day. That gives you the best information you can possibly get out of a trade. Now, I'm just trying to draw this trend resistance line in here so that I can explain it in more detail to you. You get a better feeling for it. So what I do is I draw a rectangle in here. Why do I draw this rectangle in here? You see, this is where the price comes down to. Goes back up, comes down, goes back up, comes down, goes back up, comes down, goes back up, and again over here. But the reason I draw it as a blocky is because it's not fractal, it's not maths. These are human beings. It's an area where people are putting their orders. It's an area, probably around 70. It's at 71 here. Every time the price gets down here, you can know within this area, that's an area where there's money, there's support. And at the top, it's an area. We know there's an area up here because this has been trading in a range. It's basically a range. It's sitting in that range. You could actually draw it a bit lower here as well. Sitting in that range. And every time it gets up there, it comes down. What you can do is you can actually add another one in here. Don't put too many in because you're just going to confuse yourself. But you can clearly see there is an area there where there's a lot of interest. Lots is happening here. Price, 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 price. Price got here, tried to break through, and it failed and came back. So this is a good area of resistance. Now it's trading in a range between 81 and 70. So 80 and 70. It means it's trading between 80 and 70. It's trying to get to 90. Now you know a lot more about this trade than you think. Now you've picked up a whole lot of information. It's got nothing to do with maths. It's got nothing to do with algorithms or anything like that. This has all got to do with you've picked up that this is where all the traders like to buy. This is where all the traders like to sell. Now you know. You know that it's trading sideways mostly on the daily. It's not going up or down at the moment. It's not really bullish. It's not really bearish. It's just going sideways. In the short term, it's bearish or bullish, but in the long term, it's just going sideways between those two prices. And until it breaks out, that's where it is. Now what we do is we take it back to the 4-hour chart where we like to trade. And while we're there, we'll put it back on candles. And the reason I use the candles to trade with is because then I do like to use the spikes, the tails, to see the buyers and sellers coming back into the market. I do like to see the size of the candle, how bearish and how bullish it is. You know, you get these situations where you get a whole bunch of small little green candles fighting their way up, and then you get this one huge red candle coming down. What does that tell you in all reality? It tells you that the sellers are in control. The sellers are in control because the power of the sell is massive. And then you only have to look at the overall trend. The overall trend is bearish. Now, a lot of you will say, yeah, but it's so cheap at the moment. It's getting to the bottom. That's the supermarket mentality. You can't call something at the bottom until it's actually at the bottom. The only way you can tell that you're going to do a counter trade is if this green candle breaks through this trend resistance and starts pushing higher to the upside. Then you know you've got a counter trade. Then you know you've got a trade that's going the other way. There's three ways that we trade in the market, as I've told you before. The first way is trade with the trend. The second way is trade in the range. And the third way is to counter trade. Counter trading means it breaks out of the trend and it starts heading in the other direction, or exciting trading. We've actually got two in our favor in this trade, and that is it's in the range and it's in trend. So we're short. It could go up, it could break through here. Put your stop loss where you feel that it's safe and monitor the trade. That's as easy as trading gets. It doesn't have to be complicated, guys. It doesn't have to be out of whack or out of the moon. And like I say, keep your stop losses the same on all the trades, and then you'll be okay. Why did I put this stop loss at 78.50? When I was looking at taking the trade, I looked at that's above the last high, because people talk about gargantuan whales and money searching out their stop losses. This is true because they're looking for liquidity in the market. So if they're buying large amounts of shares, they're looking for liquidity. The possibility of them finding my liquidity here is out of the norm, because the high is over here. The liquidity will be around these areas here. So I'm beyond the liquidity. If it goes through my stop loss, then I know that this is an invalid trade. It's gone the other way. But if it gets to here, takes the money and comes back down again, I'm still in the trade. Took my take profit, put it at the round number that everybody's psychologically looking for. If the price gets down to here, then we've got a good profit. And the profit, risk to reward, 2 to 1 at least, maybe more. That's what you're looking for, just somewhere in that region. Guys, you don't have to make it exact. Just make it as close as you possibly can. Now, go and listen to my strategy, which will tell you how to actually make money in the markets and how to take your small account, turn it into something bigger. So now you've seen the charts. Let's have a sip of coffee. Now you know the high probability system. But I keep telling you that the charts don't make you money. Every single video, I tell you that a win rate is meaningless. I tell you that the stock market's 50-50. Do you listen to me? I don't know. Maybe, maybe not. But I'm telling you, the market's 50-50. Why is the market 50-50? Well, I look at it as the market's made up of traders. And since every single trader's got the same belief that I do in the market that I'm going to win, then clearly I'm up against every other trader. Clearly, my trading has to be 50-50. Now, how do you make a living? How do you make a profit in a market that's 50-50? You'd say to me, if I lose 5 and I win 5, surely I'm going to end on a 0. Well, that's the whole point of the strategy. That's the whole point of getting your psychology right. Why do you think that there's so many systems out there? There's courses that you can buy that, I don't know how much they cost you, but there's courses out there that you can buy. You go on a course, they teach you a system, they tell you the system's going to give you a win rate, they tell you you're going to make gargantuan amounts of money. Some guy with a Lambo and a picture says, I don't buy this. And you go home and you know all the abbreviations, you know everything about the stock market. You're an absolute genius in the stock market. You go home and you start trading. And when you start trading, you start losing. And you wonder why. You think, but I did this course and I did so well on this course, and so many other people have done this course and they did so well on this course. What on earth has happened? Why am I losing? What's going on here? Then you realize it's all in the mind. It's all in the psychology. We've all got an inbuilt fear. That fear is what prevents us from making money. We've all got FOMO, fear of missing out. I don't like abbreviations, so I'd rather say it out loud to you guys. Fear of missing out. We've all got it. We all suffer from it. It causes us to lose in the markets. The system is easy. That system I just showed you on the charts, I can teach that to a primary school child. They'll learn it repetitively. There are people out there that learn things repetitively. Trouble is, in the market, you've got to use your brain, you've got to use your logic. See, too many of you think that the market is fractal, that the market is made up of maths, the market is made up of lines. But it's not. The market is far more subjective than you would ever believe. In fact, the market's made up of human beings, made up of traders who buy and sell. And the only way that you can make money in a market like that is by understanding that you need to make more on your wins, lose less on your losses to be profitable. It's the only way. You can't win with a win rate, because with a win rate, think about it this way. If everything was robots that were trading, if all the traders were robots, none of them were human beings. Let's say there was no human beings whatsoever trading, not even behind the robots. The robots were all on their own and they were just trading. And every single robot had the same level of programming and they were trading against each other. What would happen to the market? It would just bang into a big zero. That's all it would happen, because they all choose the right trades. Can't work like that. So the market's subjective. It's all about how human beings make their choices, how their fear affects them, how they get in and out of the markets. The only way to get around this is with this strategy, and that is you've got to take an account and say, okay, I've got $100,000 account, let's say. And a lot of you will say, but I can't afford that size account, or I have got a bigger account. Well, just let's use that as a round figure, $100,000 account. And then you risk 1% on every single trade. Well, that's what I do. If you want to do the same, that's cool. Just bear in mind, you can risk 10%, you can risk 5%, you can risk 0.5%. Depends on your risk capability and obviously on the size of your account. If you've got a small account, you may want to risk more. If you've only got a $2,000 account, you may want to risk 10% per trade and see if you can build it quickly. That's up to you. But the trick is, you've got to risk the same amount on every single trade. Every trade, it's got to be the same amount. Otherwise, you're wasting your time. How it works is like this. You take every trade and you say, I want that trade. Now, I'm going to trade this trade. But because my risk is 1% of $100,000, that's $1,000. So I only want to risk $1,000. First thing I do is I look at the trade, I look at where my stop loss is going to be. I call it an invalidation area. An area that if the price was to get to that area, I would look at it and say, I wouldn't trade that ever. Not even with your money. Not interested. That's not for me. That's my invalidation area. That's where I'm going to put my stop loss. Now I've decided on that. Now I work out how much is it back to cost? How much is $1,000 back? How many contracts can I buy? How many lots can I buy? How many pips, whatever. Then I work out the size of my trade. Now I know that's the size of trade I can take to make up approximately $1,000. It doesn't have to be exact, guys. It can be 950, 1,050. It doesn't have to be 100% exact. Just in that sort of area. Now you've decided on the size of your trade, you've got your invalidation. Now what you want to do is make sure the risk to reward is right. You want to look at it and say, if I want to make 2 for every 1 that I lose, so if I want to make $2,000, is it achievable? Is it an achievable target on that trade? I look at this trade and I look at it and I say, yeah, it's quite easy to reach that $2,000. Then it's a good trade. I can put my target there and I can take the trade. If you want to, you can take a 1-to-1, or you can take a 1.5-to-1. It doesn't have to be 2-to-1, but it has to be the same or more than what you're losing. You can't be risking $1,000 for a profit of $50. That's not how it works. But now you take that trade and you've got a good trade running. Let's say the trade goes into loss. You don't dollar cost average it, guys, because it's just going to get worse. And when it gets to your stop loss, don't move the stop loss away. Why would you? What did we say when we were talking about building this trade? We said, that's an invalidation area. The word invalidation in itself should speak volumes. It's got to an area of invalidation. In other words, why would I carry on staying in this trade? The only reason I'm staying in this trade is because I don't want to lose. But you're already losing. So you've got to learn to lose. So you've got to take that $1,000 loss and walk away. Because at the end of the day, what you want to do is maybe lose the 5 trades at $1,000 each and win 5 trades at $2,000 each. And you're making a profit. Makes sense, doesn't it? You're getting it. It goes up and it goes into profit. And you're saying, ooh, I've got $200 profit here. This looks good. Let me take that. No, sit on your hands and hold station. I know all of you want to take that profit. You're dying to take that profit because you're seeing some green. And you haven't seen some green for a long time. So you're getting a bit desperate here and you're thinking, I need that green. Leave it there. Be patient. Let the trade run. Sometimes they take a while to run. Sometimes you can be sitting in a trade for a week, 2 weeks. That's swing trading. Day trading, 99% of traders lose, guys. 5-minute charts, don't even go there if you're a beginner. You are going to get wiped out very, very quickly because you don't know what you're doing. Stay with the higher time frames. Stay with the swing trading. Stay with the day trading, position trading, and you'll probably learn to trade and you'll probably be okay. Because even on that, 70% of traders lose money. And in a game where 70% of traders lose money, why as a beginner do you think that you're part of that 30% that win? What makes you think that you're the winner in amongst all these traders? It's going to be difficult. It's not going to be easy, guys. I don't know why you think it's easy, but it's not going to be easy for you. Because you've got to get into that 30% of traders that actually win, that actually become profitable. The only way to become profitable is the way I just told you. When the price goes up to your profit, your target, move the stop loss up behind it and wait for it to come back and take out your stop loss. Don't just click out of the trade and take the profit. Otherwise, you're just going to waste all the other profit that could have gone beyond that. That's what stop losses are mainly for. That's my story. That's how you can grow your small account. You know, you can grow a small account pretty easily. If you wanted to take a funded trader account, like the one we got in the link below, for $25,000, it would cost you $100 to buy that account. And then you can qualify, and then you've got a $25,000 account, and you can get profits off that and you can make money that way. But you can only really trade $2,500 of that $25,000 account. That's how it works. That's drawdown. If you lose more than $2,500, they're going to shut you down. So why don't you take $2,500 and put it in a normal broker's account and do that as well and just risk 10% on every trade? It's the same sort of risk at the end of the day. But the difference is going to be when you lose it, you're going to lose $2,500. Whereas with the funded account, when you lose it, you're going to lose $100 and you're just going to have to buy another account. So maybe you'll be losing less with the funded account than you would be with real money. That said, with the funded accounts, what I always recommend is that when you make a profit and you're in profit and you've got that profit and it's sitting in their bank account, don't leave it there. Withdraw it and take it home with you. Put it in your bank account. I've seen guys complaining that, oh, prop firm went bust and I lost $100,000. And I think, how did you lose $100,000 in a funded account? It's nuts. Why would you even leave that amount of money in there? You know, you've paid $100 for this account. You've somehow geniusly made a fortune and you've left it all in their account. That's nuts, man. Take your money out every single month. Take your profits out every single month and walk away with them. Take as much as you can. Don't leave it in their account. That would be insane on its own. I hope that helps you. Don't forget to come back for the live show tomorrow. We are having a live show this week. Take it easy. Walk on still waters. Till next time. Cheers. Ciao. And bye.